It's time now for Futures in Focus. Global oil benchmarks are rising today as OPEC and its allies start laying out the groundwork to cut supply in 2019. Ira Epstein of the Ira Epstein division of Linn and Associates joins us from the CME. Ira, give me your early reads here. It seems like the talks over the weekend were enough to help oil prices, at least for today.
Yeah, they sounded good. The Saudis are talking of cutting at least 500,000 barrels a day in December by themselves, getting OPEC, when the meeting happens at the next OPEC meeting in December, maybe to commit to 1 million barrels a day of reduction. And this is all because the extensions to Iran that the president gave, when he gave them, no one quite knew who was going to get them. 8 countries got them. So there's still oil going in some key areas out of Iran. While there's supposed to be a 6-month moratorium on that, you just never know. At the same time, U.S. production picked up. So what the market did is it over-speculated on the fact that, if you'll recall, a month ago, we were talking, would oil go to $100 a barrel? Just now it's in the $60 a barrel range. The key is the market's probably gotten it wrong on the upside. It certainly has gotten it wrong on the downside, in my opinion. And once they take this oil off the market, you'll get back to stability. You also have to remember, in 2019, the Permian Basin, we have a lot of new pipes coming online there, and they're going to get more oil out of that. So the question is, with world economies other than the U.S. just sort of drifting along, the U.S. still doing okay, but not super robust, and the monster in the room, China, backing off a bit, just how much production is really needed to get the market in balance.
Well, you talk about the global economy. I want to fold in here the dollar a little bit. Last week, we were talking about sort of the negative correlation between a stronger dollar and weaker oil. Today, it seems like we both have a little bit of positive correlation here. What's your take on the dollar and the support here with higher oil?
Well, the dollar still looks good because the U.S. is by itself and raising interest rates while its economy is still strong. Practically no other country is doing that. We'll get a few that want to do it, and they might be able to. Canada might be one of them coming on board. The Brits certainly want to do it if they can figure out Brexit. Today, looking at that correlation is more the statement by the Saudis they're going to cut the oil than it is the factor that the dollar's going up and oil's going up. Therefore, I don't consider this really the strong correlation move. This, I think, was a watershed event where the Saudis said they're cutting oil and they're going to do it right away. And I think that put last week's lows as the number you have to keep in mind as a technician that should not be taken out as the market begins a recovery process.
I want to fold in a little bit here on the base metals. Gold and silver were hit pretty hard last week on the higher PPI reading. How are you playing this ahead of the CPI reading here on Wednesday?
I don't see anything friendly for them. Again, that dollar, those high interest rates, they are weighing on the gold market. Gold and the base metals would probably do fine if inflation were going to stick its head up. But with oil prices down $20 a barrel roughly in a month, you took out the inflation as measured in Europe, you're hurting China. As you look at all this come on, why own the gold right here? We need a reason for that, and we need the inflation story. We certainly don't have the world war stories going on. And unfortunately, 3.5% U.S. interest rates, or 3%, those type of numbers, draw money from a stock market that is struggling to stay even for the year, and that does not bode well for the gold right now.